I call David. Sorry, just
Thank you, Mr. Speaker.
David Garrett.
Thank you.
Sorry, David Clinton. Sorry, I've just had a mental block there. Green Speaker's got the floor.
Thank you. Mr. Speaker, the Greens will be supporting this bill being sent to Select Committee, given that it does establish a level of regulation in an industry where it's clearly desirable there should be some regulation. The timing is clearly interesting to the extent that the regulation of the finance sector, the almost complete absence of regulation of that sector, was clearly a major contributor to the near collapse of that sector internationally. And a great many New Zealanders have suffered real and substantial losses. Initially financial loss, but then as a result of that a flow-on effect, loss to their health, their security, their well-being, the capacity to make choices about how and where they live their lives. So it would seem appropriate for the government to have some role in regulating a very closely related industry. We're informed that the bill is intended to bring New Zealand into line with international expectations for insurance regulation, and in fact grew from a review conducted or begun by the MED in 2005. The first glance, I guess, reference to a reliance on self-discipline within the industry raised some red flags, given that the history of industry self-regulation, voluntary codes of practice, mechanisms of that nature, have at best a checkered history generally in New Zealand, as elsewhere, and not least of all in the financial sector. Ordinary New Zealanders put responsibility for a great deal of their financial security, indeed their personal and emotional sense of well-being, into the hands of insurance companies. And it seems appropriate the government should put in place mechanisms to ensure that that is well placed. Clearly the four main parts of the bill, the prudential regulation is the credit ratings, requiring that people be fit and proper persons, the establishment of a risk management program, and some minimal solvency requirements would all seem to be very sensible elements or framework for this bill. We have heard comments already that it would appear that the requirement to have capital in excess of a minimum requirement would seem quite complicated, and perhaps that's something that might be ironed out or made to be less so. The Insurance Council of New Zealand itself acknowledges that New Zealand is one of the least regulated insurance markets in the world, pointing out that in many countries, including the UK, the USA and Australia, there are insurance commissions that regulate the industry. And in some cases this extends down to almost to the level of micromanaging, to the requirements, for example, that issuing of approvals for new product releases be managed at that level. Clearly any form of regulation is going to impose cost, compliance costs onto an industry, and inevitably those will be passed on to consumers. So it's important to establish that compliant costs are appropriate, but not so onerous that they will have a negative impact on people's ability to access these services. The compliance costs associated with this bill, for the provisions of this bill, are not insignificant. It seems, for example, it may cost in the order of $40,000 a year to obtain and hold a credit rating. But in the context of the industry and its financial capacity, these would not appear to be onerous. We note there's an exemption for small players, which would seem adequate to remove these groups, such as those offering funeral insurance at a low level, for example, from the requirements and cost implications of the bill. It has been argued that such a bill is unnecessary, that the regulatory environment in New Zealand is successful, that is, the self-regulation is satisfactory and successful because the industry has been proactive in developing its own framework, which is, it must be said, multifaceted and sets out to achieve a high standard of ethical behaviour, a degree of transparency, and indeed does require proof of financial solvency. But while this may be based on a history of reliability, the same could be said for much of the financial sector up until recent times. And we know that relying on goodwill and past performance is not necessarily a wholly reliable indicator of future performance or indeed future risk. We note one element lacking from the bill is a formal mandate for reporting to the public which limits or even prevents public oversight of how well the Reserve Bank, who will have primary responsibility for overseeing these matters, how well that bank is doing in relation to the purpose of the bill. It may be assumed that the Reserve Bank would adopt a practice similar to their oversight of the banking sector following Section 165A of the Reserve Bank Act to provide twice-yearly financial stability reports. But again, this is absent from the bill as it stands, and we would expect a formal mandate for the bank to report in this way, however. Under the current, as we read the bill currently, solvency information will not be made publicly available. And while that is certainly, there is always going to be a level of commercial sensitivity about some of this information, we would expect to see at least industry-wide information to make this acceptable. Mr. Speaker, in summary, yes, we do think this, perhaps in one way, is extraordinary that we've got so long to this time without having some formal mandated regulation of their sector, and we do look forward to seeing this bill go through to Select Committee. Thank you.